Okay, excellent. So this presentation is being recorded, as I mentioned. We will be sharing this recording with everybody that has registered for this event. I know that's a question that we'll get throughout the presentation. So yes, we will be sharing the recording through a YouTube link. My name is Aileen Fernandez. I'm with the South Florida District Office. I started with the SBA a little bit over 2 years ago, worked for a United States Senator for a little bit, and then made my way to the SBA during the COVID times. I am joined by my colleague, Neil Schneider. Neil Schneider is an active member of the business community. He is a guru in his fields when it comes to getting financially fit. That's part of the series that we're presenting today. He's a consultant for SBDC in Fort Myers. As many of you know, or maybe don't know, SBDC is one of our resource partners, which they help our small businesses get to the next level. He has a lot of experience, over 30 years, both in academic and practical experience, adjunct, CPA, MBA. He graduated from Ohio State, was a pharmacist, and now works for the SBDC. So without any further ado, I'm going to turn over the mic to Neil. I do want to let you know, for those that we do have a chat. I'm going to put a message in the chat. If you have any questions during the presentation, go ahead and put that question in the chat. Neil will break from time to time. I'm going to ask if there's any questions, and that's when I'll go ahead and address them if I can address them already on my own. And that's it. I turn it over to you, Neil. Thank you so much. Really appreciate you being on here with us today.
Thank you, Ali, and welcome everybody. This is who I am. Ali already introduced me. I just wanted to share with you what I do for the SBDC. That's a small business development center. They're all over the country, and they are sponsored and supported, and in large part by the SBA with grants and financing to colleges and universities to house and host SBDCs in your local area. And I'm sure that if you went to the SBDC Florida SBDC website, you would be able to find them in your area for no cost consultation on a regular basis. So our services are at no cost to the clients. Small businesses, we help small businesses start, run, and grow. We have experts in every area of running, starting, and growing a business, from financial to marketing to international to IT, and to get contracts with the government. The pitch for the SBDC, these are the things that I typically do. It's at no cost. I do cash management, succession planning, exit planning, financial statement evaluation, development, and QuickBooks training. We also, in a large part, help clients get SBA loans so that they can start and grow their business. Little disclaimer here. This says that I'm not trying to give you any tax, legal, or accounting advice. I'm just trying to give you some information so that you can take to your advisors and discuss the issues with them. So this is strictly for your knowledge, help you become educated in the area of accounting and tax preparation. So to start with, let's talk about how you're organized. I know we have a vast group of people on online here, and many of them are organized in a lot of different ways. So every business has to report their income on a U.S. tax return. Even if you're not a U.S. citizen, if you own a business in the United States and you're earning U.S. money, you still have to apply and get file a tax return. May be different depending on your accountant or tax preparer decided how you would be organized from a standpoint of your organization, not necessarily from the standpoint of taxation. The difference between how you're organized as an organization legally in the state of Florida. For example, if we want to organize our business legally, we go on SunBiz in the state of Florida, and in SunBiz, we then tell them how we want to be organized. In many cases, that doesn't have anything to do with taxation. So below, we have a list here that says If I decide to be organized as a sole proprietor, then for tax purposes, I'll file what's called a Schedule C on my typical 1040 personal tax return. So there's no extra tax return that you have to do. You just fill out a separate form on your Schedule C, I'm sorry, on your 1040, which is called a Schedule C. And the Schedule C is a business tax return that is attached to your typical personal return. If you choose to be a partnership, then you have to fill out a IRS Form 1065. The Schedule C is due on April 15th, unless you decide to get an extension. The partnership return is a Form 1065, which is a separate tax return that you have to file with the IRS. And that tax return is simply an that tells the IRS who the owners are, what their social security number is, and everything about the business. Then every partner in that partnership will get what's called a K1 from the tax return, and then they report the income simply on their own tax return and pay the taxes on their own tax return. So it's really called what we call in the tax vernacular a entity, meaning the entity partnership does not pay taxes, just provides information to the and then provides information to the partners so that they can report the income or loss on their personal tax return. It's called a that tax return is due March 15th. It's due 45 days after the year end, assuming 12/31, it's March 15th. Why is it due March 15th? Well, you got to get that K1 to do your personal tax return, which is a 1040, and consequently that's due on April 15th. So the government requires the 1065 to be filed a month actually before you have to file your personal tax return. Then we have this S corporation entity, which is also a pass-through entity, and it files an 1120S. The 1120S is similar to the 1065, except it's for S corporations, and they also do not pay taxes, but they just report to the IRS the income and expenses of the corporation, who the stockholders are. Now we're talking about shareholders versus partners, and their personal information, such as their name, address, social security number. And they also get a K1 so that they can then report their share of their profit or loss on their own personal tax return. So a partnership and an S corporation do not pay taxes. They simply are called pass-through entities, and they pass all of the on to the individual owners of the businesses in proportion to their ownership. And then we have the C corporation, of which most small businesses are not C corporations, but the C corporation does pay taxes. So these are the corporations, like large companies, they're all C corporations because of the rules and regulations of an S corp, that you can't have more than 100 stockholders in an S corporation. Corporations have to be, all owners of an S corporation have to be U.S. citizens or residents of the United States. Whereas C corporations have none of those requirements. You can have hundreds of millions of stockholders, and they can be foreign stockholders. But the 1120 is a tax form that you have to corporation, and that tax form, on that tax form, you have to actually pay the taxes that the corporation owns. So it is not considered a pass-through entity. You get your EIN number when you start your business, the IRS will send you a letter, and that letter will tell you the tax form that the IRS is expecting you to file based upon what you told them when you got your EIN number. Now, everybody also looks at this thing called an LLC, which 95% of the people in today's marketplace register as on SunBiz and in every other state in the country, because it's just the in thing to do. So a LLC is called a limited liability. Keep in mind, it's not called a corporation. It's called a company. And if you go on Sunday, it's called a company. It's a legal entity. It is not a tax entity. So when I ask you, how are you taxed? And you tell me that you're an LLC, you're not telling me how you're taxed. You're just telling me how you organize your business on Sundays for legal purposes. So here's the deal of an LLC in the tax code. So the IRS said, we don't know how to tax this kind of entity because it's not, we don't address it in. So here's what they decided to do. By default, now keep in mind, this is called a default. The IRS will tax a single member LLC as a sole proprietor. So as a sole proprietor, what's going to happen? You're going to file a Schedule C and you're going on your 1040 and you're just going to act as an individual for tax purposes. As a multiple member LLC, the IRS is going to tax you as a partnership. What's a partnership do? A partnership files a 1065, which is a entity form, and then all the partners will then get a K1, and they will then report their share of the profit or loss on their own tax return. Now, that doesn't mean you have to be taxed that way. Keep in mind, the rule is this is the default that the IRS is going to tax you at. A taxpayer has an option to opt default at their election, not the IRS's election. So you can tell the IRS, hey, folks, I don't want to be a sole proprietor. I want to be a S corporation. I want to be a partnership, and I as a partnership is an LLC. I want to be taxed as an S corporation. The IRS says no problem. Just fill out an IRS form 2553, and 53 will then change your tax status of your LLC to a S corporation. No longer be taxed as a sole proprietor, and you'll no longer be taxed as a partnership, but you'll be taxed as an S corporation and file an 1120S. So you have total discretion of how you want to be taxed if you are an LLC. Now, which way should you be taxed? Well, that's for you and your tax preparer and accountant to discuss. The rule that you should understand is that to be taxed as an opt-out, in other words, if you want to opt out to be taxed as an S corporation, you have to file that form 2553 by March 15th of the current year that you want to be taxed as an S corporation. What does that mean? That means that if you want to be taxed as an S corporation in 2023, that form has to be filed to the IRS no later than March 15th of 2023. And if you file it later, there's a good possibility the IRS will still allow you to be taxed for the current year of 2023 if you file it later than March 15th. But then your tax preparer has to put an explanation on the top of that 2553 for the IRS to consider allowing you to use this option for the current year. So if it's late, don't file it by yourself. Take it to your tax preparer, have them put that exception on the top of the 2553, and then you have a tremendous possibility that the IRS will still approve it for the current year. But they don't need to approve it for the current year. If you do it within the first 75 days of the current year, they will automatically approve it. If you want to opt out to be taxed as an S corporation, if you are an LLC, and regardless of whether you're a sole proprietor or whether you're a partnership, it's simply your choice. Which is better for me? Well, that's again for your tax preparer and for you to talk about, because there's a lot of variables that you should be considering when you decide how do you want to be taxed. It's a simple issue to decide, hey, I want to be a legal entity and organize myself as an LLC. But now the question is, how should you be taxed? This is the decision that you have to make. If you don't make a decision, IRS has made one for you. So if you're a single member, you're going to be taxed as a sole proprietor. If you're a multiple member, you're going to be taxed as a partnership, and you just fly with that if you're okay with that, you say. Okay, so how do we keep records? Well, there's a simple way to keep records, and that's just do it on paper. Record your income and your expenses on a piece of paper, which is pretty much antiquated in today's marketplace. The second way to do it, which is not so antiquated, is to do it on Excel or Google Docs or some other type of spreadsheet. Put all your income down on a monthly basis, and you put all your expenses down on a monthly basis, and then you total them up, and then you give them to your tax preparer so that they can do your taxes. The problem with using the spreadsheets is they don't provide you with financial statements. And if you want to go out and borrow money, the lender wants to see financial statements. They want to see a profit loss statement. They want to see a balance sheet. These Excel spreadsheets or the Google Docs or any other spreadsheet is not going to provide you with that type of format that the lending institution wants you to have. Or you can use a software. I would say that 90 QuickBooks is the number one in the industry. I'm not recommending any one of them. Zoho is used by some of my clients, Zero clients, and I believe that Wave Apps is free. And may be free for a certain period of time. QuickBooks is not free. QuickBooks gives you a special for the first 3 months, and then they raise the price to the normal price. If you choose to use QuickBooks, they have two formats. They have an online format, and then can you mute yourself?
I did.
Please?
I did. We just have a lot of people. It's hard to find. I'm just going to say a reminder. Please keep your mics on mute. It's hard for me to find who's the open mic. Thank you.
Great. QuickBooks has two formats to use. One is an online version, which in today's world of technology, most of my clients choose. Subscription services you're going to pay for the rest of your life. And they also have what's called a desktop version. So you can still use the desktop version. I understand that they're thinking of discontinuing it, but that's not going to be the case in the near future. You are responsible for the information that's put on a tax return. Not your tax preparer, but you, because you signed that tax return. So the burden of proof of what's on that tax return is 100%. You have to keep all the supporting documents, and you have that your employee compensation records are secure. You can keep them manually, or you can keep them in a secure digital Dropbox. It's your choice, but they have to be there. How long do they have to be kept? Different documents have to be kept for different number of years. For example, supporting documents have to be kept for at least 3. Employee compensation records have to be kept for a minimum of 4 years. Now, that doesn't mean that the IRS can't go back more than years. If they find some anomalies in your tax return and they believe that you've underestimated your revenue or your income by at least 25%, they can go back lifetime. If they believe that there's fraud, there are no time limits of how far they can go back. So on a normal basis, it's 3 to 4 years. 3 years for supporting for a regular tax return, 4 years for employee compensation records. So the important point of this particular slide is that you have to understand you are wholly responsible for the burden of proof during an IRS audit of the revenue and of the expenses that you are reporting on your tax return. Let's slide, and then I'll stop and see if we have any questions.
So I do have a couple questions here on the chat. I apologize in advance. I have puppies here at the house and they're barking. So, I had somebody asking, well, what happens if you don't have a social security because you're not a citizen? But the company still has an EIN, right?
Yeah, you can get an EIN number with a ITIN. It doesn't have to be a number. It doesn't have to be a social security number. It can be an ITIN if you have working privileges or you're sponsored in the United States. If you do not have a ITIN in the United States. So the reality is you have to apply for ITIN. But if you a company with an ITIN, but you can't work for a company without an EIN number. I'm sorry, without a social security number. So you have to have a social security number to work in the United States to be an employee, but you can be an investor with an ITIN, ITIN number, and you can get an EIN number with an ITIN number because the
I think it's a
EIN
temporary
number,
status. Correct.
that's
Yeah,
right.
it's a temporary status that they have to apply for to work in the
Mhm.
US. Michelle also had a question. She says, when it's time for questions, I'm a S Corp with just myself as an owner. I'm trying to find out where and how I pay for taxes from my paycheck. It says it needs to be done when I pay myself each 2 weeks. I found the quarterly form, but not one where I pay on a regular basis.
If you are an S corporation and you're taking a salary as an employee, you should be filing and paying your taxes quarterly on a 941. On a 941, that's the payroll tax form that you report to the IRS about how much you made in wages, how much was taken Social Security, Medicare, and federal taxes, and how much your company is going to. You could go on to EFTPS and pay the taxes. You have to register with the IRS to pay those taxes that you report on the 941. And that's how you pay them. You pay them on EFTPS a long time in advance because it's a high security.
Right. So Neil, right. So she's got the 941, the quarterly. She's asking about every 2 weeks on her taxes.
Oh, every 2 weeks on her taxes.
Right.
If you want to make estimated, okay, that's your taxes are going to be estimated taxes until you file your own 1040. You can send them download from the IRS.gov website. You don't owe taxes until you make that money. It's a profit. So you have to estimate what the profit of the corporation is going to be, and that's what you're going to estimate that. You can then get a coupon on the IRS website to with your check, with your Social Security number to pay your personal taxes. The taxes that was taken out of your paycheck is paid by the corporation because you're an employee of the corporation, and those taxes are sent to the IRS through EFTPS.
Got it. Because she said it's still withholding tax. It's not my personal taxes as a corporation. I need to take out from my paycheck the Social Security, et cetera. I need to figure out where I pay that. So you know how you pay like the Social Security and the Medicaid, I think a Medicare, I think that's what she's asking.
Yeah, so the Social Security is being taken out of your paycheck, Medicare taken out of your paycheck, the matching of the employer, which is your corporation, okay, paycheck are reported on that 941 and then paid to the IRS on EFTPS.gov. Does that answer the question?
It's so Michelle puts on what form I went to ETPS, and that's not the place where I pay that portion. It's not. I think she needs to probably speak to you a little bit offline. I'll share Neil's information. She needs to
When-
set it up, and I, once you set it up, it happens automatically.
When you set it up, you'll get a password from the IRS. You'll sign into it, and then there's a drop-down menu that says which form are you paying taxes on. You'll choose the form that says 941, and then your ACH, in other words, which account do you want to take it out of, and then you'll put in your routing number and your check number, and you type in the amount, and then you hit submit. It'll give you a receipt, and it'll take the money out of your account, and then that 941 for that taxes that were withheld are paid.
Correct, right. Okay, she says she's going to reach out to you anyways individually. Anna asked, how long do we need to keep all the documents for tax purposes? I thought it was 7 years.
You have to keep your documents and then payroll records for 4 years.
So payroll for, I'm sorry, because you broke up. Payroll
Yeah,
for 7?
No, payroll for 4 and taxes for 3.
Oh, only for 3?
Yep. The
Oh, so
IRS can only the IRS can only go back 3 years unless they find a large error, and then they can go back 7 years.
Oh, okay.
You say,
Got it.
so my recommendation is you keep them for a long time. Because if they find fraud on your tax return, they can go out lifetime.
So, and okay. Awesome. Let's see who else. Let me see if I missed any other question really quickly before. Can record keeping be done with QuickBooks? Any training offered with QuickBooks? Rosie's asking.
You can keep records in QuickBooks because for every transaction you do in QuickBooks, there's a option to attach the document for that transaction. For example, if I go to Staples and I buy office supplies, that's a transaction I put in the QuickBooks. There's a paperclip symbol in that next to that transaction that allows you to upload that receipt. So yes, you can keep documentations in QuickBooks.
Excellent. There was one more question. Hold on a second before that. Where can we find a tax preparer to help with record keeping?
Well, I think I think the best place to go is to go to your local SBDC, and they'll probably have a list of those tax preparers, and then you can then interview them. As an individual with the SBDC, our SBDC doesn't allow us to recommend any one or company, but we give you a list of 3 or 4 that you can research yourself.
Right, because it is a personal decision.
That's right.
David asked, if I have contractors overseas, which documentation should I save for those transactions? Are emails or Word invoices enough?
Yes, invoices are what you really want.
Okay, excellent. And then
And also with the invoice, you're going to have check stubs, or you're going to have ACH withdrawals, or it'll be put on a credit card. So you have not only invoice, but you have proof of payment.
okay, perfect. Of payment. And then last thing, and then we'll keep on with the presentation. Anna asks, do we need to keep receipts, or is just a credit card charge enough?
Credit card charges are not enough, and that's on one of my slides.
Oh,
The IRS wants the
boy,
original
oh boy.
documentation.
Okay.
And that's on one of my slides as we move forward. Absolutely.
Okay, so I'll let you continue on. Thank you so much, Neil. We'll break in a couple minutes.
Sure. So confirm. So let's look at record keeping. We need to confirm that all the books are balanced and closed for the end of the year. We have to look at all of our transactions and make sure that they're recorded properly. In other words, they're in the right category. We don't have, excuse me, we don't have assets in the expense side, but we have assets on the balance sheet in the asset side. So when we buy a vehicle, when we buy equipment, when we buy machinery for our organization, we need to make sure that we properly as assets on the balance sheet and some. You may have expensed them, but we need to review our record keeping to make sure that we have corrected it. We need to reconcile all the bank and credit card statements. Why? Because that's where you're going to find the mistakes in your QuickBooks or in your bookkeeping system. They need to be reconciled. It's standard of practice to do it every single month. Every single month, you download your bank statements, you download your credit card statements, you reconcile it with your bookkeeping system, and you correct the errors at that point in time so that you don't have a big job to do at the end of the year. You need to hire the right accountant or tax preparer. Keep in mind that all tax preparers are not accountants. Some people that are not accountants are still tax preparers. That doesn't mean that they're not qualified to do taxes. I'm just telling you that they're not all accountants and they're not all CPAs. There are a lot of people in this world that prepare taxes, and that's okay. But you need to interview them, and you need to be a little bit knowledgeable about who you're going to hire to do your taxes. And you need to make sure that when you connect with somebody, that they can not just do your taxes, but give you some advice and recommendations of how to keep your records, where to keep them, and review your documents and give you some feedback. What are supporting documents? Well, it's not the credit card statement and it's not the checkbook register. You must have the receipts. You must have the receipts, and that's why QuickBooks and other software allows you to upload that receipt with the transaction. So that if you want to go to a transaction by Home Depot or Lowe's or someplace, and you say, what did I spend this money on? I don't remember. You can click on that document and you can pull it up and you can see what it is. If the IRS wants to look at why you spent this money, they can click on that. You can click on that paperclip and you can see the receipt right there. You don't have to go to the bank statement. You don't have to go to the credit card statement. You don't have to go to the debit card statement because they are not satisfactory documents for an IRS audit. Mileage records are the same way. Mileage records require you to have a log. So that log has to have the date, why you're, the business purpose, and the beginning miles and the ending miles. Meals, same way. Receipt. You need to have a receipt of why you are deducting these meals as a business expense. What was the purpose of the business engagement? So what you need to do is start thinking about locating and organizing those records now before the end of the year and before it's crunch time to file your taxes, whether it's March 15th or April 15th. Supporting documents of assets. Well, if you buy an asset, document that shows what you bought, the date you bought it, and how much you paid for it. So this is a purchase order. This is an invoice, whether it's a vehicle or whether it's a piece of equipment, you have to have that document, and that document can be uploaded the same as you would any other transaction and attached to the transaction of the asset. You have to have the cost of any improvements. Again, you'll have them invoices. Deductions taken for depreciation. You have to have documentation of why you took that deduction for depreciation. Or if you chose not to do depreciation and you chose to expense it in the year in which you purchased it, you have to have documentation for that reason. Now you can say to me, well, how do you decide whether you depreciate or you expense that asset? My answer to you is you would have to go over the pluses and the minuses with your tax preparer, because some assets could be depreciated, or you can take the expense immediately in the year in which you purchased it. And that's called a Section 179 expense. How the asset is used. It's very important to understand how the asset is used and what's the selling price. Why do we care? Well, if you sell it, you have to pay capital gains tax on that asset, or you get a capital gain loss. If you sell it for less than what you paid for it. And you have to report the expenses of the sale of that asset. So these are all the you need to have good supporting documentation of every asset. You know, when you buy 3 or 4 vehicles for your business, like if you're a dry cleaner and you have 3 or 4 delivery vehicles out there, you need to identify those vehicles somehow or another in your assets by either a VIN number or by some other way, so that when you sell that, you can then take it off of your balance sheet and report either a capital loss or a capital gain on it. So you can't just put on your asset side vehicles, 3 vehicles, $750. Every piece of equipment that you buy has to be listed separately, so that when you sell it, you can then identify which one was sold and how much it's sold for, and whether you owe taxes as a capital gain or whether you get a capital loss on it. So it's very important. Inventory. On your tax return, you need to have documentation of the cost of your inventory. Canceled checks, cash receipt, tape receipts, credit card sales slips, invoices, purchase orders, all these will prove the purchase of inventory. Then, of course, we know that inventory is going to be sold, or we wouldn't be buying it. So for the expenses of it, we need the same thing. When you sell inventory, it's called cost of goods sold. So under the cost of goods side, we then have to be able to identify what inventory. On the tax return, there's a specific spot to put in what you purchased during the year and what you sold during the year and what your ending inventory was. And consequently, that will spill in a number on your business tax return of your cost of goods sold. So it's very important you keep good records. So in my view, this is a good tax preparation checklist. Get last year's tax return. Take a look at it. Organize your filed tax forms. In other words, all year long, you have filed a 941 or a 944. And at the end of the year, you file a 940, which is a summary of the 941. You send out and file your W-2s to all your employees, and you file the W-3 to the IRS and Social Security Department. Get this together. For all of your independent contractors, today we file a Form 1099 NEC. We do not use the MIS form any longer. We do not use 1099 NEC. NEC stands for non-employee. When you hire subcontractors, you should have a W-9 that you had them fill out. And then if you use a software package to put them in as a vendor, you can then have the software package print out the 1099 that you have to send them. Who do you have to send them to? You have to send them to anybody who you have paid $600 or more during the year. $600 or more during the year. Doesn't mean you can't send them to other people, but you're required by law to send them to every single person that or company if they're not a corporation, and that W-9 that they signed for you will let you know how they're organized. So you send those out, and they have to be sent out by the 1st of February. Think about a retirement account contributions. At the end of the year, you need to see if you have enough cash to make a retirement contribution for yourself and possibly for your employees. You can do that in the next year. You have a period of time to do that until you file your tax return in the next year. Planning processes that you need to think about. Think about any new assets you might need, and maybe you want to buy those in the current year so that you can or the expensing deduction in the current year. And you have to look at your company's bad debt. Keep in mind, if you're a cash payer, you do not have bad debt for tax purposes. Now, that may not make sense to you, but let me explain it to you. If you're a cash paying taxpayer, you're only paying taxes on the cash that you receive. You're not paying taxes on your accounts receivable. Since you're only paying tax on cash received, you're not allowed to write off money you can't collect from your accounts receivables because you haven't paid taxes on that yet. So consequently, from the standpoint of tax purposes, there is no bad debt write-off for cash paying taxpayer. It's true that you have receivables that may never pay you, and you can write them off on your accounting books, or you can try to collect them or turn them over to collection. But they're not a tax deduction because you've never paid income tax on that receivable. If you're a cash paying taxpayer, therefore you cannot deduct it as an expense. Now, if you're an accrual paying taxpayer, then you have paid taxes on your accounts receivable. And if you write off bad debt, that becomes a tax deduction because you've already paid taxes on that person that they owe you. And if you can't collect the money, then you get to write it off as an expense. Sounds a little complicated, but if you think about it logically, totally logical. You can't write off something that you have not paid taxes on. That's the bottom line. And after this slide, I'll open up the chat box again. So the other checklist, in my view, is you have to report all your income. Now, I don't care if you collected income in cash and put it in your pocket. It's still tax. You're required by law to report income tax return. I know that some small businesses collect cash, some small businesses get checks, some small businesses get paid by credit card. Every single dime that you receive, no matter what the means of payment is required by law to be reported as taxable income. That's the first thing you need to understand. Second of all, the new law that went into effect for 2022 says that your credit card company, so any payments that you receive by credit card, you're going to get what's called a 1099. That 1099K is going to report to you all the income that you have received through your credit card processor. Therefore, you better report on your tax return on that statement, because guess what? The IRS is getting a copy of that. Okay? And consequently, you have received all that money according to the credit card processor through credit card payments to you. So if you Shopify, on Etsy, on Amazon, it's all going on a credit card typically. Well, whoever's doing your processing for you is going to send you the 1099, and all that better be shown on your tax return because the IRS has gotten a copy of it. That's not to say that you don't have to report more, okay, if you're doing business other venues, like let's say you're doing business and people pay you by check, or you're doing business and people pay you via cash. The reality is all of your income's got to be reported on your tax return, but you better show at least what the IRS is getting from the 1099s that people are sending you and from the 1099K your processor is sending you, because if not, it's going to bring up a red flag. You must report all the sales regardless of whether you receive a 1099 or not. You need to take advantage of the capitalization rules. That means the depreciation and the expenses of assets. You need to collect current financial statements and bookkeeping records. You need to look at your home office deduction if you're entitled to one, and we'll go over that in another slide. You need to understand what auto expenses are all about and be able to bring that up to date for year end. This is your checklist for tax preparation. And you need to look at your meal expenses. And all these things are being proactive, or that you have a checklist for your preparation. You want to stop here if there's any questions? No questions? Can you still hear me?
I have a question.
I hear you.
Yeah, okay.
Is it possible to get these slides emailed?
Yeah, she said at the beginning, she's gonna email them to everybody.
Okay, I apologize. I didn't get in the beginning. I was trying to get on my computer and I had to get on my phone.
Yeah, Ali is going to provide these slides. It's being recorded now, and she's going to send you a link to a YouTube channel, a private YouTube channel where there'll be.
Awesome. Thank you very much.
Uh-huh. Any other questions?
Yes.
Yeah.
I have a question about inventory. I work as an artist, and so I wonder if there's a specific way as an artist I need to keep track of my inventory, because it's inventory that I've created or things that I've made that have not been sold yet. So would I have to have the value of those items assessed, or is it just the price that I've set? How would I keep track of inventory in that way?
Well, the inventory you would keep track of this of the stuff that you create would be what it cost you to create that inventory. Okay, has nothing
I
to do with the
apologize.
value.
Your volume went all the way down, so I missed part of what you said.
Yeah, the important thing is that you keep track of what it costs you to create that that product.
Okay, so you mean
Yeah,
like supplies and materials?
Right.
Okay.
Right. And then the value is what somebody's willing to pay you for. So that's the selling price, you say. So the difference between what it costs you to produce that product and what what you sell it for would be your profit on your cost of goods sold.
Okay, thank you. So
Mhm.
what I'm doing is I'm essentially combining the cost of materials to, so all that would be included in the selling price anyway, and the amount
That's
of time
right.
to produce it.
That's
Okay.
exactly right. That's
Okay.
exactly right.
All right. Thank you.
Uh-huh.
I have a question.
Uh-huh.
About the discount. Can we deduct the discount from taxes?
Say that again.
And when we give discount to customers, can we deduct that from taxes?
Well, when you give a discount to a customer, let's think about your profit and loss statement, okay?
Okay.
You're going to let's say hypothetically that you sell something to the customer for $100 and give them a $10 discount, okay?
Okay.
Well, your profit income of $90. So you're not deducting it. But you're reporting the $90 of income. So on your tax return, you're showing $100 worth minus returns and discounts of $10, and then your net income is going to be $90.
Okay. All right.
So you're not paying taxes on the full amount. The tax return itself will allow you to deduct it to come up to your net income, but also the software that you use should also deduct it. So you show the full amount, and then you show discount to the full amount, and then it should show you your net income for the year.
All right. Perfect. Thank you. Thank you so
Uh-huh.
much.
Sure.
I have another question. Can you hear
Go
me?
ahead.
Yeah, I can hear you.
Okay. Thank you. Mr. Neil, I'm in a consulting business, and most of our consultants are in Latin American countries. One of the challenges that I have been facing is that sometimes I have to take the money out of the bank through a cash withdrawal from an ATM, and I send that money to the consultant through someone that is flying to the country, because or when I'm flying to the country because of business purposes, I take the cash with me. I don't know if that makes sense. My question is, how can I be in the safe side, and how can I defend these expenses? Because in my bank statements, it only shows a cash withdrawal, but this is an independent contractor overseas. I don't know if this is making sense.
invoice.
Excuse me?
The contractor overseas that you're paying needs to provide you with a written invoice, a document to show that you owe them the money. And that document
said-
then will support the money you're taking out of the bank account to give to them.
Okay, so for example, they send me an email with the invoice. That email is enough proof?
That email with the invoice is enough proof from my standpoint to be able to document why you took the money out to pay them. You can pay
Sorry.
them cash as long as of the invoices. Absolutely.
Mr. Neal, you broke. You said that it is enough proof or it is not. I'm sorry.
Yeah, from my standpoint, it would be enough proof. I would check with your tax preparer though.
Right,
Okay.
he's saying that he thinks it would be, but you should speak to the person that prepares your taxes, what they
That's
feel
right.
comfortable with, if they or, send documentation to the IRS.
Right. I would feel comfortable with the invoice supporting the amount of money you're taking out of the bank to pay them for the expense. I'm not saying that business related. So it's got to be business related or it's not a tax deduction. But the invoice itself would be a document that would support why you're taking it out.
Perfect. Thank you so much.
Sure. Move forward with general business expenses. These are typical expenses that people have. Meals. Well, the last 2 years, meals were 100% deductible if you could prove that there was a business purpose. During the Trump administration and during the pandemic, Congress increased the meals deduction for 2 years only from 50% to 100%. This was to restaurant business during the pandemic. This is over in 2022. So the 2022 is the last year that you're going to 50% deduction for business meals. And entertainment, when they passed the executive order to make meals 100% deductible, they eliminated entertainment. So they gave you something on one end, but they eliminated something on the
Took
other
out
end.
something on the other. Okay, good to know.
Yeah, so this was only a 2-year deal during the pandemic. And in 2022, there is no, in 2021 and 2022, there was no entertainment deduction. So if you took someone to the ball game, you couldn't deduct it. If you took them to a restaurant, you could deduct 100% of it. So that was the give and take that Congress and the executive orders did for the pandemic.
Was that the only exception? Because I see here that you also have travel and, I mean, is that the only thing that they swapped out for 100?
No. Travel has not changed. These are the only two that changed on the tax return. And that's why I'm highlighting them first, is because starting in 2023, it goes back to the old way that meals are only 50% deductible and entertainment is 50% deductible. But in 2022 still, and this is preparing for the 2022 taxes, you cannot deduct entertainment, but you can deduct meals at 100% of the cost if it's for business purposes. Now, travel, you need to have documentation of why you travel. So if you went to a conference, if you went out of your vicinity to meet with a client, and if you drive within the geographic area of your particular community, that's not considered travel. Travel means that you stayed overnight. And consequently, you would be allowed to deduct your transportation costs and your hotel and your meals. So it's not a travel expense. If you're traveling, for example, in my area, I live in the Naples area, west coast of Florida, or if you live, if I travel from Naples to Bonita Springs to Fort Myers, that's within the same vicinity. They're just kind of suburbs, even though they're saying different cities. That is not travel. And consequently, if I stop at Wendy's to get a meal, that's not tax deductible. If I stop at a restaurant, it's not tax deductible, unless I'm taking a client. Now, if I'm taking a client to lunch, then that would be tax deductible, you say. But if I'm out of town and I am staying overnight, then my meals would be tax deductible. Don't forget all your advertising that you do, your websites, your signs, your business cards, your ads that you place, all the money that you pay for social media, that's all considered advertising. People think that if they put, especially home watch people, they think if they put a sign on their automobile, they can deduct their automobile. The sign means absolutely nothing as far as an automobile expense. The sign
Got it.
means, the sign means that you have an advertising cost to prepare that sign and to pay a sign company to make it. But just putting a sign on your automobile or your vehicle is not a, doesn't make your vehicle a business deduction. It's the use of that vehicle that makes it a business deduction. So keep that in mind.
So
all
on
your
that
legal-
point, Neil, on that point, just because I have a couple questions. Can
Okay.
somebody please stop muting me? Thank you. If you buy a new car for business, can you deduct the full car expenses?
That's on the
Or
next
what
slide.
would qualify you deducting a business, I guess, car?
That's on the next slide. So let me hold that off until the next slide.
Excellent. Okay, then let me ask another question that they typed here. So, can you write off fees that for credit card company that, you know, so that when you process a credit card, the credit card company takes out a 3%. Can you deduct or write
Absolutely.
off that processing as a business expense?
Absolutely. Processing fee, and that's how I do it on my taxes.
And then one
Uh,
last question. If you pay an electrician $600 to set up your office, you have to fill out a 1099.
Say that again.
If you pay an electrician to do some electrical work in your office, $600, do you have to
Uh-huh.
do a 1099?
If they're not a corporation, you have to do a 1099.
So if you're paying an individual person, anything over what amount do you have to do a 1099?
$600.
Okay, excellent. Thank you. Go ahead, Neil.
They could be a business, but not a corporation. You still have to send them a 1099. So they have to be being taxed as a corporation. 1099, and they will tell you that when you have them fill out the W-9 before you do business. So legal fees and accounting fees are all deductible. Business insurance, licenses, permits, internet, cell phones, bank fees. That's what you were talking about. As far as the processing fees, interest on the loan is tax deductible if it's a business loan, but not the principal, because the principal is paying back the money that you borrow. People deduct the whole thing, and the principal is not a tax deduction. It's just repaying back. Now, the loan has to be in the business name. I have too many clients use their personal automobile for business, and that's okay, but you can't deduct the interest on that because the vehicle has to be titled in the business name. The vehicle has to be titled in the business name. There's other ways to get around that through a reimbursement from the business to the owner of the vehicle. In other words, whoever it's titled to, but you need to talk to your tax preparer. Okay. Let's go into the home office deduction rapidly, and then we'll go to the business. I know it's after 12 o'clock already. There's a way to deduct a home office deduction if you are eligible. The IRS says we don't need any records. Okay. Just take $5 per square foot to a maximum of 300 square feet, and you can deduct a maximum of $1,500. No records are necessary. The room just has to be eligible for a tax deduction. So if I have 200 square feet, $5 times 200 is $1,000. That's what I would deduct. If you don't like that method, then use the long method. So calculate the ratio of your office space of the total usable space of the house, and do the ratio of the utilities, the repairs, the insurance, the mortgage interest, and the property taxes. It's your choice. But first you have to qualify. You have to prepare that you have a qualified home office expense, and you can do it either Here is the question about your vehicle deduction. Okay, so there's an easy method of vehicles. For 2022, since the gas prices went up, the IRS has two mileage deductions. One is 58.5 cents for the first 6 months, and the second 6 months is set 62.5 cents. You must log all mileage that you're taking, the purpose, the mileage, and the date. We already went over that. You must elect in the first year that you buy a vehicle, if you want to either do the mileage or if you want to do the actual. And notice below this is the actual, the detail. The actual is that you would deduct the fuel, the oil, the maintenance, and all of the items above, the lease payments, the insurance payments, and the tax payments. You would deduct those individually on your tax return as automobile expense or vehicle expense as a proportion of you using that vehicle for business. So if you use it 100% for business, you deduct 100% of it. If you choose the mileage rate, that mileage that the IRS is giving you includes gas, oil, repairs, tires, insurance, registration, licenses, and depreciation. Okay, it includes all that. So you can't deduct that and the mileage. You either deduct the mileage or you deduct the actual expenses or the detailed method. Keep in mind, if you lease a car, you must stay at the mileage for the entire length of the lease and the renewal of the lease if that's what you chose the first time you put that leasing car into business use. You must stay with that mileage, whether you like it or not, the second or third year. So you and your tax preparer need to do a calculation of what you think it's going to cost you in actual expense and how many miles you think you're going to drive, and then make a choice of which one you're going to use. So that's
Just
all
an
about
observation, Neil. It would seem that the detailed is easier than every time you mile,
Well,
do a
the
mileage.
the detail is actually harder because you need better records.
Oh, I
So
see.
you gotta keep all your receipts for everything you do in your automobile. Whether you get a new tires, whether you get fuel, whether you take it in for an oil change, your insurance costs, your tax payments, you need like the documentation for every one of those things. And then you add them up and you manage use of the automobile. With the mileage is all you have to do is log why you are logging that mileage, how many miles you went, and the date you did it. You don't have to have any receipts. You don't have to have gas receipts. You don't have to have any of that receipts. So actually, the easiest way is the mileage. The toughest way is the detailed method or the exact amount. But you need to figure out which works best for you in the first year that you make that vehicle for business use. So in summary, we always need to be proactive. We have to have a plan. We don't want to wait till the last minute. We have to understand our responsibilities and our account. It's not your tax preparer's responsibility and not their accountability. And you have to understand that there are tax extensions that are always available if you can't get this done on time. So you can get, if you're a S corporation or a partnership, you can get extension until September 15th. If you are a individual and filing a Schedule C on a 1040, extension until October 15th. But the extension is not for what you owe or anticipate what you owe. It is for the filing of the return. So you still need to do some type of estimate of what you think you're going to owe and send that estimated amount to the IRS by the due date. And that's it. A little overtime, but we got there. Any other questions?
I'm gonna go ahead and there's two questions, and then I want to be mindful of everyone's time and of your time, Neil. I will be, like I mentioned, sending this recording to everybody that registered for this event. They asked, I'm a realtor and I went to Cambodia, I'm sorry, to meet with potential clients who are eligible to buy the house in the US. Can I deduct all of my travel expenses like airline tickets, food, etc.?
House in the US?
They want to buy a house in the US, but she went there to meet the clients.
Yeah, if the house is used for business purposes, once you buy the to the cost of the house, absolutely. But it's got to be used for business purposes. If you're going to stay, you have to take a proportional of how much time you spend there versus how much time you actually use it for business.
Got it. And then Jonathan asked, my sister and I are the owners of a small business, but we are not seeking to receive pay / funds from business yet. Instead, we would like to pay my father as a contractor. He is not an owner or manager of the business. Would we need to file this under a Schedule C on the Form 1040 or a partnership for 1065 using a K-1?
If he's not an owner of the business, it wouldn't be a 1065. If it's not an owner of the business, then and the owner of the business is a sole proprietor, then you would actually just file a Schedule C on the 1040.
Right.
And give your father or father-in-law a 1099 at the end of the year if you paid him over $600.
Right. So the K-1 is only if he has ownership.
That's right. The K-1 is only for partners or stock S corporation. That's right.
Okay, excellent. I don't see any other questions at this time on this chat. Thank you so much, Neil, again for a great presentation. I want to invite everyone to join us for the last webinar that we will be doing on the Financially Fit of this series. We will be hosting other series in 2023. Our next webinar is actually looking it up is on January 17th, and it's how you organize your company for tax purposes. I'm going to go ahead and add, I'll add the link on the chat and so that you guys can join us the same way that you joined us for this one. Oh, Sonia, one last question. Sonia asks, when we interview the tax preparer, what questions should we ask?
Well, the first question I would ask is, will you provide me with consultation and not just do my taxes? In other words, I need help in understanding
What I can and cannot be doing. Yeah.
And consequently, advice of the best business practices to use. If your tax preparer is just, they're not going to provide that to you. If your tax preparer is also a tax preparer and a consultant, they will provide that to you. Hello?
Thank you. Sorry, I got stuck. Thank you for that, Neil. Okay, so I'm gonna go ahead now and end the recording. I will let you know that I couldn't find the link, but what I'll do is that I am sending this recording to everybody registered, and I'll send the link for the next Financially Fit, our final Financially Fit series for 22, even though it's going to be in 23, so that potentially you guys can join us. Again, thanks so much for your time. And until next time, thanks, Neil. Have a good one.
You too. Bye.
Bye-bye.